Hey guys, welcome back to another video. Today we're going to be talking about 5 common mistakes that commercial bankers make when they usually start off their career. And so this video is made for junior commercial bankers. Obviously, people that have been in the role for 5 to 10 years have kind of built the habits necessary to survive the sales cycle and generate the business. But if you're starting off your career in commercial lending, you have no background when it comes to any kind of business, COI, referral networks, relationships with accountants or lawyers or anything. You're just starting out, coming out of university, like I did when I first started my commercial banking job, then this video is made for you. And so this video is really tailored from my own mistakes. Looking back now, I spent about 4 years in commercial lending, primarily lending between $1 to $40 million in term loan sizes for a big Canadian bank in Toronto, Ontario. And, over the years that I worked for the bank, I kind of look back and said, you know what, I would have changed these few things, and it probably would have helped me achieve success a little bit quicker and find and originate deals a little bit better. So just as a quick overview, this video is going to be dedicated towards more commercial bankers focused on the SME space. So not mortgage lenders, not anyone that's providing residential or retail products. This is more for business lending solutions. And if you're providing those types of solutions. And so ultimately, when I think about success in this role and trying to really develop the skills necessary to succeed, I always kind of start from, well, what is and what does a very good banker look like? Kind of distill the key skill sets and traits of that banker and then really focus on achieving those skills. And so, when I first came into the lending world, I kind of looked at the rainmakers, the shooters at the bank, and naturally the very first thing that you'd see is they were confident and focused. And they were really determined on getting in the morning, making their sales calls, going to client meetings and client lunches, and delivering on what they wanted to do. They were very knowledgeable. They knew about a ton of sectors, and they were very good generalists in the sense that they could jump between sector to sector and comment on the outlook and the economy and everything. They were very good in terms of communication, and they had a very clear sales approach, consistent, repeatable actions every single day. And they were very good on details, even though they were high-level sales type oriented people. When required, they would get involved with the details, and they would really listen to the client to understand what they need rather than just throw out a loan with the cheapest interest rate. Because at the end of the day, that's not really how you win deals over the long term. And then naturally, that all kind of ties into the ABC, which you always kind of hear in the movies, which is you always got to be selling. And so every day they were investing a certain amount of time, even if they were closing deals, underwriting loans, they were still actively investing time into sales activities. So that's really the key to success here. Now let's look at the mistakes that I made that really were kind of away from this. So the first one I would say is, and I kind of shake my head looking back now, but a lot of junior bankers, myself included, I just never really wanted to invest the time to track my meeting notes, to track the relationships that I had, and put it into the bank's CRM system. And my bank had a Salesforce, right? And so, funny enough, all the senior executives would say, "Please update your Salesforce on a weekly basis or monthly basis." Blah 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 blah. And I sat there and I'd roll my eyes and I'd say, "You know what? I don't want to do that. I want to sell. I want to go out and make more calls. I'm not going to invest 5-10 hours a month to update my notes." But the reality is, if you don't do that, now in your first year when you maybe have 20, 25, 50 contacts and you obviously have a young brain, you can remember all those people, it's easy to keep track of 50 people. But in years 3, 4, 7, 10, now those people that you met in the first year that maybe you're not touching base as frequently, but maybe there is a good lead there that you can call upon. If that's not tracked and recorded in a central area where you have that Rolodex and that database of information, then you'll let those early contacts slip through the cracks. And that's really what I've experienced, right? In my early years, I didn't invest in a sales CRM system. Now in my investment banking business, I live and breathe that CRM system. Every single day I get on my calls, I do my CRM meeting notes and everything because it's critical to staying on top of a network where now I know probably 1,000, 1,200 people that are live COIs that I'm working with. Well, it's almost impossible to keep that all in your brain. You got to put it somewhere. And so building that habit to leverage those CRM tools is a very key success factor for early bankers, because the moment that you've developed that, there's certain features within that program that really help you. The first, naturally, is when I look here as the meeting notes. Those meeting notes, when you touch base with that person, you usually can personalize that a little bit based on your past call. And what I usually do now is, if I have a call with a prospect and they say, hey, I'm working on this deal, blah, 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 I'm going to close this piece of real estate, touch base with me in a few months. The next time I reach out to them, I say, hey, how did that real estate deal go? Were you able to close, blah, blah, blah? Let me know if you're looking at any new deals. And so you've already personalized the message, and it's like, oh, he remembers. Oh, okay, you know what? Let me pick up the phone and call Robert. And so those are kind of the things that, again, it's the small things, but it gets the reply. It makes sure that you at least keep in touch with people, and it shows a level of attention to detail that other bankers won't follow through on. The other thing is the follow-up campaign itself. CRM systems, they track the information, they track the email addresses, the contact numbers, and all that kind of stuff. Developing a mailing list, and then setting reminders that every 4 or 5 months, a ping comes up in your email that says, hey, you got to reach out to these 10 people because it's been 4 months since the last time you've talked to them. All of those things are excellent, because in sales, follow-up is key. Usually in your first meeting, you're not going to get the lead. In the second meeting, maybe. In the third, fourth, fifth, that's when you pick up the leads. And so maybe you've met that person, but if you don't follow up that person, in most instances, those first meetings get wasted. And then if you try to touch base with them in 3 years' time, it just shows a lack of care for that relationship. So setting those meeting reminders is key. And again, a CRM system does that for you. That's the very purpose of this system. And again, I would look at that and I'd say, I know who I need to follow up with in fall or in winter. And again, that's just not possible when your network continues to evolve and grow as you spend more and more time in that role. So this may work in your first year, but by your fourth year, you're not going to be able to sit on top of your network. You're just going to know too many people. Now, also another thing is, when you're tracking your calls, for me, I just know my KPIs. I know how many calls I need to make on a weekly basis, on a monthly basis. And so with sales, part of it is the whole mental game of motivating yourself to keep knocking on doors. Well, when you're looking at a CRM and you're tracking your number of calls, you can visually see, hey, I made 20 calls this month, I made 30 calls this month. My goal was 15 for both of those months. So even though I didn't pick up a lead, I'm reaching out, I'm knocking on doors, something's going to come. And so it keeps you motivated, it keeps that engine running so you can keep pushing and pushing. Again, that all comes down to you tracking and knowing that you're doing enough calls to eventually generate those leads. And then lastly, especially with the banks, a lot of these CRM systems, they're centralized. So multiple regional offices or multiple divisions will be on the same system. So leverage that information. If you reach out to ABC Inc. and you see that another partner is already working with them, or that group has previously called upon them, then maybe work together and reach out to that person, or read up on their meeting notes. Hopefully they've taken some, and go into that meeting a little bit better prepared. And then the other thing is, the reality is there's so much turnover at these banks that you may be tracking a prospect that's already covered by someone else, and that person leaves the bank. And passover of relationships is terrible at the banks, and that's why a lot of clients complain about the banks, because they don't really take good care of them. But if you're at the bank and you're saying, oh, you know what, that's the perfect time to reach out, because that person's now left. You have their information, their contact details, and the meeting notes from the previous person. You pick up the phone and say, hey, Johnny just left. Boom, you poach that. Now, a little bit ruthless, but that's what I did. That's how I picked up a ton of good leads. And in most instances, that banker's probably not transitioning that relationship anyways. So why don't you do it yourself? Right? So I think this is one of the very first ones I always think about. And when I'm talking to kind of junior lenders, they just view it as added work, when in reality, it should be part of your sales cycle. And you should always get in your mind, I spent an hour on the call, allocate another 10 to 15 minutes for those meeting notes, because it's critical and it should be required. Now, the second thing is the whole approach on cold calling. Now, this typically applies to, again, business lending type solutions. If you're, a mortgage broker, you're selling retail products, credit card applications, et cetera, direct calling is a little bit different, because, ultimately retail customers, there's such a big group of them, and it's the law of, large numbers, you're eventually going to pick up leads. But when you're working with business owners, trying to call business owners direct, unfortunately doesn't work. And the reason why is that it's so overcrowded today. There's a ton of real estate brokers with the valuations being so high. Like, business owners are constantly getting called upon. Like, what makes you different? You're going to put on a nice voice. That's not going to make you different. And the reality is you're working pretty hard for probably a low rate of return. I'm not saying you're not going to get leads. I did this. I mean, I was the guy that, I looked at this and I said, man, no one else is cold calling in my office. I'm going to start doing it. I was blowing my brains out for like 6 months trying to call people. I got some leads, but at the same time, I probably wasted a ton of time that I could have been more focused on developing what I would recommend to you, which is COI, referral-based selling. And so centers of influence essentially is a term used for professional partners that are working with the clients that you want. So an accountant is the accountant to the business owner that you want, the lawyer to the business owner, the business advisor or the CFO consultants. Those are common COIs that you'll see in the lending world. And so instead of calling direct to the business owner and trying to reach 10 owners, why not call one accountant, focus heavily on getting through to that one accountant who may provide access to 10 potential prospects or 100 prospects if they're a big accounting firm, right? So instead of focusing on targeting the end customer, which is the target customer for you, focus on the partners that work with your customers and develop relationship with those partners. And so now, many years down the line, I'm still in the sales world, but selling businesses instead of, financing solutions. I do the same thing. I focus on wealth managers, on business bankers, on commercial bankers, and they will introduce me to their clients who are thinking about selling. And it was the same thing when I was in the lending world. I was focused heavily on accountants, lawyers, not so much for me, and CFO consultants. The CFO consultants and accountants were the two really good areas for me. And they were naturally working with a ton of business owners. And when they were thinking about buying a piece of property, who do they go to first? Well, their accountant. Can I afford this property? Can you help me with structuring the deal? Blah, 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 right? So they're usually the first people in the room, and they can make that referral to you if obviously they're looking for financing opportunities. Now, additionally, within your existing book of business at the bank, your own clients can also be COIs. So say, for example, you did a deal, you built a good relationship with a business owner. We'll ask that business owner for an introduction to their accountant who may have other clients that are looking for financing. Ask that client for introductions to his CFO advisor or an introduction to his customer or supplier and getting in front of other companies. So leverage your existing network or leverage the people in front of you to access the next layer of people. Instead of reaching cold out, you go through a warm referral, and that typically brings a higher rate of return. And that's the thing with cold calling. The challenge, especially in SME lending, is that unlike retail products where, there's an immediate need from a retail customer, it's a quick transaction, switching banks, borrowing money is a long sales cycle. And so if you're reaching out cold, maybe a prospect will pick up the call and ask you a few questions and express an interest. But are they really motivated to switch banks? You don't know that. And you may be chasing a ton of leads that may not convert anywhere. So you want to focus on the COIs who will then refer the people that are motivated to sell or motivated to borrow money. Because again, an accountant will only refer you to a business if they're looking to meet the bank, right? And looking for financing. So in my opinion, cold calling in the SME space is a low value approach. And so early on, especially when you don't have a network, you've just graduated university, you're 1 or 2 years out of school, you don't really have a lot of contacts. It's better to focus your time on developing 10 relationships with accountants rather than 100 direct relationships with businesses. Because those 10 accountants over time will refer more work to you than those 100 businesses. Okay? So the third mistake, and this is another one, a biggie for me, was, usually at the banks, especially the large banks, there's multiple divisions. You got the wealth management, the private banking, retail banking, small business banking, specialized lending groups. There's a ton of groups, right? The bigger the bank, more groups. And unfortunately, a lot of junior bankers, again, the pressure, I just remember when in my first year, I felt this immense pressure to deliver on my sales budget. I had to call. I had to meet as many people as I can. Like call. I just got to get these loans out because naturally there's that sales pressure. And it was my first time really in a sales role. Well, naturally, one area that I overlooked was inside the house, inside the bank. And so it took me a while to really appreciate the value of internal relationships. And so what I mean by that is, say, for example, you got a wealth manager and you're a commercial banker. Well, that wealth manager has a book of business, and maybe some of their clients are already banking with Scotia or with your bank, or some clients are not banking with your bank on the business side. And so typically when there are big moves like buying a company, buying a piece of real estate, that wealth manager will be involved in that decision-making process with that business owner. And so if you're known and you're made aware and you're in front of that wealth manager, well, that wealth manager can ask a simple question. Hey, maybe go talk to Robert and see what he can do for you. And so boom, you've gotten that lead. And so really there are internal COIs within the bank that are coming across leads. They're doing their own prospecting, knocking on their own doors. And maybe that lead is not for them, but it is for you. And so by partnering together, you ultimately do bring in more business. So it is COI selling at the end of the day, but instead of focusing on external COIs, don't forget the internal COIs. They're just as important. And I'll give you a good example. So we work with RBC, big Canadian bank across the US as well. RBC does an excellent job at joint meetings. And what that means is they'll bring the commercial banker, but they'll bring a private banker, and they'll bring a wealth manager, or they'll bring a product industry specialist. And so instead of bringing one person to one meeting, one prospect meeting, they're bringing three or four partners to that meeting. And so by bringing that full team in front of that client, it communicates a ton of credibility, a ton of invested time and seriousness. And that usually communicates a high reputational level for that bank, which obviously increases the chance of closing on that deal. And naturally, you may be bringing a partner to your meeting, and that uncovers a potential opportunity for them as well, and vice versa. Maybe now they're bringing you to their meetings, and you're sitting there and you say, oh, you know what, let's keep in touch. Whenever you do need business financing, please reach out to me, and thanks, Mike, for bringing me along to this meeting. So by going to more and more meetings, you're meeting more and more prospects. So leverage someone else's sales efforts and join them, and naturally vice versa, like bring them along into your meetings as well. And so by working together, you typically do expand your network. And so for me, in my early years, I used to roll my eyes and be like, that's just a waste of time. I want to focus externally. But the reality is there's really good value in having one, two, three key internal partners that are BD focused like you, that are working in different areas, that are not competing with you, and that when a deal comes up, if they know what they're looking out for, it may be a deal for you that you can pick up the phone and work together on. And then the last thing over here at the bottom, and this is one that I didn't really appreciate this when I was at a bank, but now that I'm in the investment banking world, I'm working with all of the banks in the marketplace. And so I can kind of see that there's not a lot of good cross-bank inter-lender relationships. And what really good lenders can focus on, and I think not a lot of people are doing this today, so I'm just giving you this tip and advice. And now if I were to go back into commercial lending, I have these relationships, so this would be an area of opportunity for me, is if you can develop relationships with lenders that are not competing with you, but are still within the same vicinity and the same space, then there's an opportunity to really refer potential business back and forth. So a really good example is, say, for example, you work for a large Schedule A lender, and there's a private lender that you have a relationship with. By targeting the private lender is focused on high interest, higher risk projects. Now, that private lender may need those projects to eventually be refinanced by a more traditional lender. So you get that deal flow. And in addition, they're reaching out, they're knocking on doors, they're doing their sales thing, and they may uncover potential opportunities and say, hey, you know what? This may be a deal for Robert. Let me flip you and introduce you over to Robert. And that's the key. Now, obviously, you need to do that vice versa too. You need to start referring opportunities that maybe are a little too high risk. And usually, especially with the commercial banks in Canada, who are a little bit more conservative, I had a ton of deals that would pass up. And by being able to refer it to a higher risk lending partner, you get that lead. Potentially, they may get that business opportunity, but then they see you generating value for them. So they'll start thinking of opportunities for you as well. So the cross-lender, cross-bank relationships is another really good area of sales opportunities that I would recommend you pursue. Now, mistake number 4, for myself, I didn't really have this issue. I mean, I was just obsessed with going out and meeting as many people as I can, but I do see this now with COVID. Obviously, a lot of commercial lenders working from home. They've been really heavily reliant on Zoom and virtual meetings. And so there's this almost hesitancy to go and meet people in person. And obviously, there's a convenience to picking up the phone or meeting over Zoom because you don't have to drive out there. You don't have to sit for an hour and a half with the same person. You just can have a 30-minute meeting. But the reality is, do not underestimate the value of in-person meetings. Think about it. I'm explaining the cost of time to go out and meet someone. Well, think about that from the person that you're meeting. They too will also have to incur that cost in terms of time invested. So when they go out, that's a serious commitment of intent to work together, intent to partner and focus on each other. And so you get to stand out. So say, for example, you want to meet and develop a relationship with an accountant. Well, the reality is a bunch of commercial bankers are going to be calling on that accountant. COI referral selling is not new. But how do you stand out? Well, there's the small things like follow-up notes, sending potential referrals, making recommendations, sending articles, whatever the case is. But the simple truth is, in the post-COVID era, getting that accountant to go out to lunch, having a great time, having a personality, developing a personal relationship with that accountant will go a very long way to keep picking up leads that may be referred to another banker. So that's really important. Now, for potential prospects, business prospects, or existing clients as well within your book, site visits are another thing. This one I committed myself. I remember when I was managing 75 business owners in my book of business when I was working at the bank. And I didn't go and do 75 site visits a year. And the reality is I didn't even go and do 30 a year. I should have done more. And that's one area that I probably would be working on if I went back into that role, is investing the time to go to site and meet your existing client or meet potential prospects. And the reality is business owners love to show off their business, show off the equipment, show off the facility. This is what I'm working on. And so when they're going through that spiel, you're going to be listening to things that they need, their challenges. If you ask good questions, you may uncover things that will result in either a potential opportunity now or later on. And I'll give you a really good example. I had a prospect. I inherited a client from another banker who had left. And so this client, no one visited them for 2 years. Okay. And so I go out, drive 2.5 hours to see this group. They were making lights, manufacturer of lighting equipment. And I'm touring the facility. I'm sitting here and they're saying, yeah, we desperately need more capacity, equipment capacity. And so I said, hey, you know what? Why don't you think about financing equipment? And they're like, well, we don't know. I mean, we just, the business, the variability and all that kind of stuff. And we started talking about the equity in the building that they own. And, we sat down and an hour later, we were talking about a $2.8 million equipment facility leveraged against the business, against the building. And, kind of cleared up some misconceptions. And the reality is that conversation, I wouldn't have had that conversation if I just picked up the phone and say, hey, how are you guys doing? Is business good? Okay, bye. But I toured the facility, I listened, I asked questions, and I was able to uncover opportunities. So even for direct prospects and business owners, doing a site visit should not be seen as a cost of time, but rather as an investment and a potential learning opportunity for you. Because now I've learned about the printing business or the lighting business. I can take that knowledge to my next prospect and talk about, hey, do you have that piece of equipment? And you sound like you know more than you may do, but at the end of the day, you're leveraging knowledge across different site visits, and that's really important. So for sure, site visits is something I'd recommend you always take up and do because it's just worthwhile to learn. And then the last thing is, again, in a post-COVID world, conferences have been virtual. And as conferences are going back to in-person, I remember pre-COVID, when I was in the commercial banking world, conferences were the highest rate of return on my time. Guaranteed. Because people that are there are willing to network, are there to network, and they're the type of people that want to meet new people in most instances. And so when you get in that room, if you're focused, you're confident, and you're hungry, and you meet a lot of people, you could walk away with a dozen or so contacts that it would have taken weeks to develop and prospect and cold call, email, over LinkedIn, whatever the case is, but within a day. So conferences are still a very high value solution for commercial bankers. And I'll be honest with you, outside of the main kind of finance related conferences, commercial bankers are not going to the expos. They're not going to the business related conferences because, again, it's seen as a cost of time. Naturally, there's a cost there, and hopefully the bank is going to comp it for you. But still, that's a lot of valuable potential referral relationships there. So get in front of those people. Now, the fifth mistake is really when it comes to talking and managing expectations for a prospect. And this one is something that I thankfully kind of learned very early on. I had a good mentor internally within the bank, but I've seen other bankers and I've worked with bankers now being on the opposite side where they overpromise and underdeliver. And the reality is it's such a simple lesson, but people often forget that, when you say something in person or when you say something on the phone, oh yeah, I can give you that leverage at this price and blah, blah, blah. The price comes at 50 basis points higher, or the leverage is a little different than what you said on the phone. Like that sticks out and is killer. It's killer for your reputation in the marketplace. So one thing, especially for junior bankers that are just becoming familiar with the job, with lending, with the lending products and getting deals done, especially in those early deals, make sure that whatever you say in person, whatever you manage in terms of expectations is dead on. If you miss the mark, that is very difficult to recover from for that relationship. And I've had the one-off instance where I've mismanaged an expectation and kind of dodged the bullet, kind of had to eat shit, but that's the way it is. And the reality is for those kind of situations, you're not going to see a lot of opportunity for them unless, obviously you kind of address it head on. You say, hey, I made a mistake. But I would say for sure, if you're focused on developing really good relationships with people that are typically older than you, you've graduated university, but you may be talking to a 40 or 50-year-old accountant or business owner, it's important that credibility is protected from day one. Because if you're a young gun and, you mismanage expectations, then, not only do you get penalized because you missed it, but because you're young, they'll probably question your overall credibility to get the deal done. So what are some things that you can do in this situation? Well, the first thing, and I always say this, when someone asks me, hey, I just got a commercial banking job, what do? I tell them, learn your product. The first 3 months, you should be reading deals, past deals, and really understanding the lending programs so that when you're managing the expectation, you're talking about a deal, you don't misquote and you don't misguide in terms of structure. The second, develop a clear communication line with your risk manager. I would always pick up the phone or walk over to my risk team and talk to them about a prospect before I really kind of finalize terms on the term sheet, just so that they would know and just so I could kind of bounce ideas off them. And sometimes I'd be like, listen, we got very little appetite for that sector right now. And no one tells you these things. You kind of figure it out along the way you go, but the reality is, if you're talking to risk, you get very direct feedback right along. And say, for example, there's a unique aspect to the deal. There's a bit of a stretch, something that's a little bit off program. We'll clear that with risk before you commit to doing that for the client. And that's really critical. And then the third thing is communicate openly with your client. So, if you don't know, it's better to say that you don't know and that you're going to look into it than say, yeah, I think we can get it done. So it's critical that you're open. And to be honest, like a lot of bankers, sometimes to save face, they won't say that. But I remember in my early years, I would just be honest. I'd be like, listen, I'm hungry. I want to do this deal with you. I'm going to work harder, 10 times harder than anyone else. But let me just triple check if I can do that. I don't want to mismanage your expectations. And they're like, yeah, that's fine. And, I come back a day later, within 24 hours, I give them the answer, and they'd be like, okay, I want to move forward, or no, I need that, and I can't do this deal with you. But, I would manage their expectations and communicate openly. And I'll even give you a good example, a really good story here. So in my second year on the job, I was managing, so I brought in this potential buyer that was buying a HVAC business in Canada. Really large transaction, like $30 million. And so, I ran the deal by risk. Everything seemed to be okay. We're going through the underwrite, and then we uncover some things about the buyer. We also uncover some things about the industry and the risk related to the industry. And through every step of the process, when I uncovered a new risk factor that lessened the probability of the deal getting closed, I'd pick up the phone at the end of the day and I'd call the buyer. And I'd say, listen, Mike, this is happening. This is what we've uncovered. Risk are kind of, a little bit nervous about this. We're talking through it right now, but I'm just telling you this is where we're at right now. Just letting you know. And so throughout the process, I made a few of those calls, and at the end, we invested about 3 months, and the deal got declined. And I remember I was thinking, I'm going to have to pick up the phone and say, sorry, we can't move forward with this. I'm embarrassed. I can imagine the client's going to get very, very angry. I pick up the phone, I deliver the news, and the client's like, you know what, I had a feeling just based on the earlier calls, but, thanks for pushing and trying to fight for me. I appreciate the work that you did for me. And funny enough, that buyer, even though I didn't get that deal done, is now a longtime client of mine on another deal because it came back and did a deal with us. And the reality is, because I made those calls and had those early tough conversations, I managed their expectations. And when I dropped the bomb, it didn't blow up in my face. And that's the reality. Communication is key. And most junior bankers, either they lack the confidence or the will or the thick skin to have those conversations early, and they change the terms late, unexpected. You have to put yourself in the shoes of the business owner. If they don't know what's going on, it's a black box with risk management, then, when something comes out of left field, they're going to get mad. So provide that openness, communicate frequently, and have those conversations earlier on. And then lastly, in saying all of this, I'm not saying that you shouldn't commit to terms, because the reality is the other mistake I usually see is that junior lenders don't know their product. They don't know the programs. They go into meeting. They're like, I don't know if we can do this, or I can't really give you terms right now. And so then we can never have a substantial, real conversation about what a deal could potentially look like, because you don't know the product. So you should be providing some details around cost, structure, pricing, whatever the case is. But if you are, don't be too aggressive and overpromise, and instead provide ranges and mention it's subject to this, it's subject to this, manage those expectations. So this is a key one. This is something that, I thankfully learned early on, but I would recommend that you guys really kind of apply these lessons here. So overall, these are kind of the 5 main mistakes. CRM tools, making sure that you're using them to track and develop and scale your COI network and your contacts. Making sure that you're focusing on high value COI targeted selling rather than direct, especially in the crowded SME market. Failing to leverage your internal banking partners is a key sin that I did not apply for a long time. So find someone that understands your product, that's willing to work with you, and those leads will come from those people internally, because naturally they're loyal to keeping the business within the bank. Make sure that you're investing time in in-person meetings, especially in the post-COVID world where everyone's conveniently just recommending virtual calls. That in-person meeting is critical. There's a time investment from both parties, and for some people, they prefer it. And again, you're typically going to see physical reactions and different types of emotions that you won't really see over virtual mediums, and that's really valuable for someone that's selling. And then lastly, make sure that you manage client expectations and never change the terms in a term sheet between the term sheet and the credit offer. And if there is a change, the client should be aware of it early on, not at the end of the process. So overall, if you do avoid these mistakes, this career is going to be very rewarding for you. But I just always caution that because this is a bit of a sales treadmill, there's constant work and constant focus on developing really good habits, and over the long term, you will see that success. So, and then the last comment I'll make is, especially in a crowded marketplace, you may be working with large groups and people that are focused on that sector that you're targeting as well. If they're going left, I always say go right. Try to find different ways to approach that same marketplace. And that's why I say, if everyone's doing direct calling, then don't call direct. Try to go through the COIs. If everyone's focusing on the sector and focusing on the big deals, focus on the small deals first and work your way up. There's different niches within each of the categories that you're focused on. So make sure if they go left, you go right. Okay, so that's it, guys. I appreciate your time on this one. If you have any questions, please do comment below. And for sure, for any commercial bankers that are watching this video, I would love, love, love to hear some of your mistakes that you made early on the job. Comment below. We can kind of start a conversation there because I'm sure there are a ton of others that I missed in this video. I just wanted to kind of share the mistakes that I made when I first started out in my career. But hopefully you liked the video. If you did, please do like and subscribe to the channel for more, and we'll see you soon. Thank you.